advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome back to another episode of Something More with Chris Boyd. My name's Jeff Perry. I'm sitting in for Chris today, and very happy to have with us Chief Investment Officer Brian Regan joining us. He's a regular on the show, of course. And Brian, thanks for taking time out of your busy schedule. I know you're busy today, but thanks for spending this episode with us. How are you doing?
I'm doing great, Jeff. How are you?
I'm doing good. Lots of stuff in the news this week, of course. You know, we say that all the time.
Always is, right?
It definitely seems to always be that way. There's always something in the financial news to chat about. Before we get into the subject of the day, I have a question from one of our listeners that I want to get you to opine on a little bit. But before I do, I don't want to forget to remind listeners that Brian did a webinar. He did last week or the week before, did our third quarter 2023, of course, economic and market update, where you reviewed performance, how you look at things moving forward, and you focused on, we certainly talked about inflation and market distortion and the Fed and all these things that our listeners are very in tune to. Our listeners are very focused on markets and the economy, obviously, if they're taking time to listen to this episode. They're focused on these things. And you did was about a 45-minute webinar on these subjects that is now posted on the front page of our website for you to go back and look at. It's also on YouTube, our YouTube channel, and links are on our various social media outlets, including Facebook. I almost said Twitter. I guess I still can say Twitter, X, whatever it is, Instagram, LinkedIn, and so forth. So if you haven't seen that and you're interested in these deeper dive, if you will, on these subjects of the economy and market, go to amrfinancial.com and you can take a look at Brian's quarterly webinar. So with that, Brian, I want to start off not by talking about stuff in the news, although if we have time at the end of the episode, we can go into it. But we had and I know this is a loaded question, and I know we got 20 some odd minutes. Somebody asked about different ways to look at stocks, and specifically they wanted an explanation, and take it wherever you want to go. They wanted an explanation of what does fundamental analysis means when you're looking at a given stock, or if you want to apply it to the greatest stock market, however you want to explain it. The technical term, I shouldn't say that because it's technical analysis. The term I'm looking for is a definition of fundamental analysis and how it plays into the things that you do.
Yeah, so interesting. I'll start off by saying, and this is truly an opinion, but I think it's a strongly held one on my part. If you are asking this question, you should not be buying individual stocks. So keep that in mind. I'm strongly advising against buying individual stocks if you do not understand even the definition of fundamental analysis. And I don't mean that to disparage anybody. I mean that as a reality that you just don't have the tools. It's like trying to build a house, and you don't have nails, wood, or a hammer. I mean, you just have nothing, right? So with that caveat, what is it? Fundamental analysis is the only way, in my humble opinion, that you should evaluate any stock. Stocks are ownership in a business, and what fundamental analysis is basically analyzing the fundamentals of the business, applying a valuation to that business, and comparing that valuation to the price that is currently being held in the market. So of course, we could go talk about this forever, right? How do you evaluate the business? How do you evaluate businesses different ways? And
talk about what some of those fundamentals, some of those pieces, or I assume they're different for different businesses or different sectors, right? But talk about some examples of what some of these things that you're looking at are.
Yeah, I mean, Jeff, you've heard me say it probably a bunch of times, but the most important things are the persistence of the business, the consistency of the business, and the growth of the business. So, you might look at a staple that's been around for 100 years, take Procter & Gamble or something like that. I personally prefer in that space Church & Dwight. But these are, Church and Dwight owns Arm & Hammer. They sell laundry detergent. They should sell baking soda. This business has been around for a long time. I believe that it's likely going to be around for the foreseeable future. And that, I'm not going to say certainty, but that confidence that you have about the consistency and the persistence of the business makes it so that business will have a relatively high value versus a business that is inconsistent and not necessarily persistent. So compare that to a newer company that has that's a cyclical industry with maybe a lot of competitors and no brand awareness. So what am I really talking about? I'm talking about, does the business have a competitive advantage? The competitive advantage can come from cost. It can come from technology. It can come from brand. It can come from a lot of things. But competitive advantage likely leads to consistency and persistence. And those are, obviously things that you want to look for in a business. Secondly, growth is typically a very good thing for a business. Not all the time. Sometimes businesses grow too fast, and they get themselves into debt issues and people issues and labor issues. But generally speaking, a business that's growing at a nice clip is a good thing. And you're willing to pay up for that too. So the Golden Goose is a business that trades at a very attractive price that's consistent, persistent, and growing. They're few and far between, but I think ultimately that's simply speaking the fundamentals of the business that I'm looking for. I want to make sure I pay a reasonable price for it.
So when you're looking at any given stock, you can give an example, or you can just keep it generic. How much consideration do you give on the economy specific, or maybe some government action or outside forces outside of the company? How do you think about things that may impact a company's earnings and a company's stability and persistency that maybe they don't have any direct control over? How do you analyze those things or factor those in?
When choosing individual stocks, that is not really a consideration. I think that's a much bigger consideration when it comes to the overall asset allocation. How do you want to move the battleship rather than what kind of battleship you want to be on, if you want to think about it that way. That's what the outside factors, I care most about. But sometimes it does play in. Let's take, for example, the CHIPS Act that the United States passed. And I'm using this as an example of when it does play in, but I really want to emphasize that you want to look for stocks that are consistent and persistent and growing despite whatever the government or outside forces are going to do. That's, ultimately called bottoms up, analysis. And that's what you want to do when you're choosing stocks. But let's take the CHIPS Act, for example. The CHIPS Act is designed so foundries will be built in the United States, if you want to just simplify it down to that.
Right. Moving the production of semiconductors from places that may not be stable was the goal into
very specifically States. Taiwan. That's
right.
Mostly made. They're mostly made. Most of the semiconductors in the world are made in Taiwan at Taiwan Semiconductor. So the goal is to onshore a lot of that production. Now it takes $20-30 billion to build one of these foundries, one of these fabs. It's not cheap. So you might want to look at something like the CHIPS Act and think that is going to cause a trend that could last a long time. And you could think about what are the companies that are going to benefit from that trend that's going to last a long time. Hopefully it's going to last a long time. And then you start doing your bottoms up analysis. What parts of the semiconductor industry are going to benefit the most from this? What parts of the semiconductor industry are attractively priced? Which ones have good management teams? Which ones have a competitive advantage that's going to be consistent and persistent, and be able to take advantage of the tailwind that hopefully you'd get from something like the CHIPS Act. But, that's one example. And I really want to stress that, I say it every single week, I feel like, but keep your politics out of it. Don't think about it too much, especially when you're choosing individual stocks. As we know, individual stocks are a whole different animal from, selecting an ETF or a mutual fund.
Right. Thinking about things like the CHIP Act, if an individual investor is looking at it like this, and I think your advice at the beginning of the segment is right on point. Like, if you don't understand this, good question, still good question. We want you to learn. We try to be teachers as well as advisors, and in your case, analysis. But we try to teach people through these podcasts and radio shows and webinars and newsletters. We want people to learn. But if you're not at that point where you understand it and willing to, take those risks, your risk assessment is proper, and all those things, you shouldn't be investing in. So I think your point was right on. But I want
let's talk about why that's important too. Right?
Sure.
So
yep.
So you spend you let's say that you have the tools, right? You have the tool belt, you have the nails, you have the hammer, you have the wood that you need to build the house to actually analyze a stock, right? Let's keep that analogy going. So you analyze the stock, and let's say you think the stock is worth $100 a share. It trades at $110 a share. So you stay away from it. You're not really interested in it, but you keep monitoring the price. For whatever reason, Fitch downgrades the U.S. credit rating. Let's take that as a topical example.
Sure. In the news, right? Yeah.
The stock falls, 20, 30%, and now it's trading at $80 a share. So you have a stock that you think is worth 100, that goes to 80. Well, you buy it because, hey, look, I got it.
It's on sale, right?
It's a deal at 20% undervalued. Well, what do you do? What do you do if these outside forces that you talk about, continue and the stock goes to 70? Well, do you sell it? Well, you think it's worth 100. You did all the work. You have the tools in the tool belt. I'm not selling it. In fact, I'm looking into whether I want to buy more. Does it make sense for my overall asset allocation? If it goes to 60, do I sell it? No. Same analysis, right? 50, same analysis. And if you think that what I'm saying is a rare thing, then I really want to caution you against buying individual stocks because it is extremely common. Extremely common. I'll give you an example. Netflix used to trade at $750 a share and fell to 170 within 6 months, something like that. I don't have the chart in front of me, but it happened really, really quick.
Yep.
So, was the right price 700? Was the right price 170? Right now it's trading around $430 a share. These things can move around a whole lot, and your buy decision in the short term or sell decision in the short term should have almost nothing to do with where the stock is currently where the stock is currently moving or trending. It just shouldn't, because if you're investing for the longer term, eventually the price is going to keep pace with the fundamentals of the business. It's Warren Buffett says in the short term, it's a voting machine. In the long term, it's a weighing machine. And, that's the closest thing I have to a religion, quite frankly. So, I think if you don't do that fundamental analysis, you're not going to have the confidence to do the right thing at difficult times.
Not only getting that analysis right, but not being influenced by things that are in the news that can be very portrayed as very dramatic and very meaningful, and to have that discipline and focus to stay on your own analysis, so someone that you trusted, and stay in the trade, if you will. If nothing else has changed, just because there's a lot of noise outside doesn't mean that you should make a move. And I think that's where many individual stock investors don't have the stomach for something like Netflix that you described, that sudden drop in a price, or are really impacted by politics, as you said, or something in the news about Fitch downgrading the Treasury's credit rating, or other things that come in the news, Russia, China. They really make emotional decisions, which is when you're making an emotional decision, usually about when to sell a stock, quite frankly, it's usually the wrong decision.
Well, we all know that we should buy low and sell high. The ultimate question is what's low and what's high. And if you don't know what the company's worth, it's impossible to make that determination. So you need to start with, what's the company worth, and what's the company valued at? What's the value of this company? And value is what you get, not what you pay. The price is what you pay. The value is what you get. You want to make sure that the price you pay is, lower than the value of a business. And the world gets a lot simpler when you start thinking that stocks are just pieces of a business. No different than buying a partnership at the local deli. There's really no significant difference at all, except, one trades hands every second of the day,
Right.
and one doesn't. And that liquidity can be a good thing, but it can be a stressful thing for people too. But if you're going to be buying individual stocks, step one, what is this company worth? Not what it's priced at. What is it worth? And I apply that to every situation in my life too. I remember a few years ago, I was shopping for a house, and the real estate agent just kept saying, I was like, that house isn't worth, $500,000. I'm just picking a number.
Right.
And he goes, it'll sell for $500,000. I go, that doesn't mean that it's worth $500,000. To me, it's not worth $500,000. And that is, it's a very good skill to have in life. And it makes you make very disciplined decisions in all aspects of your life if you learn that there's a difference between value and price.
Yeah. And I think that's where many people who maybe they don't put the label of day trader on, or maybe they're just trading in months or weeks or even years, but they make those mistakes. Then the data is so clear that so many people make these emotional decisions. And in fact, they're getting in when everybody's in, when the market's roaring and it's, the news is pushing like stock market's up again, record high, or up 30% this year. The data shows, and it's not just this year, it's every year, that more people are jumping in at the top and more people are jumping out at the bottom, meaning they're in most cases, they're making the exact wrong decision at the wrong time because they're getting carried away by the emotional factors that you're talking about. And,
I guarantee you, if you ask the average person on the street, is the stock market more or less risky than it was in October? Almost everybody will say it's less risky.
Mm-hmm.
And how can that be? I mean, the S&P 500 is just a collection of stocks, ownerships in businesses. And that ownership in the business costs a whole lot less 9 months ago than it did today. So, if you look at stocks as pieces of businesses, I'd rather pay a cheaper price than a more expensive price. So, almost by a matter of math, it's riskier today than it was 9 months ago. It's
right.
just the reality of it. I mean, it certainly doesn't feel that way, which is why I hate the word feel. I feel this is going to happen. I actually wrote down a list of things that have been bugging me, and I'm going to turn it into a blog. But the terms that everybody's doing this or nobody's doing this is absurd, especially in when it comes to investing, because if you're selling a stock, somebody's buying it. That's just the reality of it.
That's right. It's a market, whether or not you recognize
somebody's happy to take it off your hands at a lower price.
Right.
But, if you don't have a fundamental understanding of what you're buying and why you're holding it, then, that everybody, might seem like everybody, but it's not everybody. It's half the population of people in the market are doing the exact opposite of you. It's just the way it is.
When I talk to people who are, I don't know, I almost said the word playing around. That might be another one for you. But
that's number 2 on my pet peeves. I'll tell you my third one too. It's also related to this.
That's funny.
Yeah, I really can't stand it when people tell me how we're going to play the market. This isn't a game. I'm not playing roulette. If you want to do that, go play roulette. It might be fun. Go play craps. This is not something that we play. If I buy an ownership stake in a local restaurant, I don't think it's all fun and games. I've worked in restaurants. It's a lot of hard work, that business. So I wouldn't look at that as a game, and I won't look at buying, Netflix as a game either.
Well, this is exactly where I wanted to go, because when I talk to people who use those terms or have that sentiment, I often say to them, do you really think that you're going to be able to react faster, do a better analysis, be more informed, make a better decision than people who are doing this professionally with a lot of experience for decades, and it's their sole function in life to make these decisions? Do you think you're smarter, faster, better than them? And if you do, you're a bit delusional. So on that subject, you're a full-time guy. You have credentials. You're a certified financial analyst. You're a chief investment officer. You do this all day. What percentage of your time do you spend doing fundamental analysis on investments and analyzing our portfolio or additions or subtractions? What part of the day or week, however you want to frame it, is focused on this particular subject?
I'm obsessed with it.
I knew that.
I'll just start there. It's not like just something that I do between 9 and 5.
Fair
I
enough.
do it between 12 and 5 because, quite frankly, I have trouble sleeping. So I
12
I have 3 degrees in
midnight.
this stuff.
Right.
I've spent a lot of money and a lot of time learning it. If you don't understand accounting, if you don't understand accounting rules, I mean, the chips are so stacked against you. You can't reasonably make a valuation analysis of a company. You can't really have that emotional control that you need when a stock sells off 10%. After it reports earnings, if you can't fundamentally understand what they're saying. I wrote an article a few months ago about misleading things that were happening in markets. It was basically a big rant about things that were making me upset, ethics wise. Mm-hmm. And one of the big parts of the article was talking about adjusted earnings. Companies always beating on adjusted earnings. And I've seen some wild things get added back to those earnings. Mm-hmm. And if you don't fundamentally understand that, you could get tricked by these games that companies play that are designed to have anchors on CNBC parrot that they beat.
Sure.
Estimates when maybe it's total nonsense. Jack Welch was famous for never really having a bad quarter, right? But now we know that he's dead.
This is General Electric, right?
Yeah, and GE is really tanked. But there was a lot of earnings manipulation going on for a lot of years.
Right.
And those are the kind of things that you might just not have the tools to be able to recognize. There's all sorts of behavioral biases that go into investing, and we all have them. And if you don't have the tools to do the fundamental analysis, I mean, you're just going to struggle to avoid those behavioral biases.
Yep. And there's a practical side of it, back to my, do you really think you're smarter than everybody who's in this business full-time doing it, experience, degrees, credentials, and all that? And there's a behavioral side of it. Even if you're spending the time and have some experience doing it, do you have the emotional ability to be in the market through these, your Netflix example is perfect, through these ups and downs of it all? And 99, I don't know, point whatever percent of the individuals do not, right? So that's when you either turn to a professional, like a company like ours, AMR Financial, and if we can help
even professionals aren't good at it. I mean,
many are not.
Overwhelming amount of evidence that most active managers don't perform over the long term. It's very difficult to do. So I'm very happy, and I would never get in a situation where, or I don't think I would get in a situation where I would be expected to perform on an annual basis, because I think it's a crapshoot. I think markets can do what markets do. Like I said, it could be a voting machine in the short term, and 1 year is very short in this business. So, when you make an investment, you better have the guts to stick with it and have confidence. And I tell my wife, I think it's a personality thing. You almost got to be stubborn, right? When the world says you're wrong, you got to put your foot down and say, "No, I've done the work.
Yeah,
I've done the work. I think I'm right." And you all reap what you sow.
Stand by, right? Stand by, because Brian, we're out of time for this episode. Thank you for taking the time out of your busy schedule and for joining us and giving us your insights. We appreciate it.
Thanks, Jeff.
If you think AMR can be a asset to you, can help you with your financial planning, or if you'd like us to take a second look at your financial plan, check us out on the web at amrfinancial.com or give us a call at 508-771-8255. 888-8900. And thank you for listening, and keep striving for something more.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.